Welcome to Striking Options, the show that reveals the options you have to better navigate markets. I'm Jeff Kilburn. We've adjusted our show until we can get back into the studio. I'm joined today by Bob Icino. Welcome, Bob.
Good to talk to you again, Jeff.
Well, Bob, another fascinating week. Global stocks continue to be in rally mode on the recovery hopes and also vaccine news. We're seeing the S&P 500. We're seeing the NASDAQ 100. We're seeing them continue to move higher. But I want to talk about two topics today, if we can dig into two specific topics. Sound good, pal?
Sounds good to me.
All right, well, let's first hit the S&P 500. It vaulted 3,000. Think about that, Bob. That had such a substantial move, about 40% off those lows that we incurred on March 23rd. But the question I proposed to you, is this more technical or is this more emotional? And how much higher can we go?
Well, I think it's a little bit of both. Obviously, the jump above it is emotional. You're seeing optimism in some of the consumer confidence, forward-looking numbers. In other words, future economic sentiment, which is definitely the emotional part of it. But it's technical as well. Once you break above levels like 3,000, you tend to see follow-through.
What's interesting, we're actually seeing stocks overseas on the upswing as well. But this is all related to the economy's reopening and us gauging, having optimism. Or is it more of there's possibly a vaccine on the horizon?
Well, I think that's part of it from an individual stock basis. And when you see the reopenings and the prospect of a vaccine, you see economic growth that's been going on in the States, not necessarily being a blip, but being more of a sustained move. And since equities trade in the future, that's why equities are moving this way, in my opinion.
Well, great point. And lastly, I just want to touch on the CME. CME Group does a great job of providing a consolidated, combined, total reportable short positions. We saw those short positions obviously move higher in the month of March. Right now, they still are elevated. Are there too many short positions in the market? Is that also a potential catalyst?
It's definitely part of the reason that the market is holding up, because on every dip, you've got these short positions covering, and then you've got new ones being initiated. When you look at the non-commercials, which is what we consider to be the speculators, that actually crept up. But you're right, the CME cumulative is a really good tool that especially index traders should be watching on a weekly basis.
Really interesting. Well, hey, let's shift gear quickly. I want to talk about the dollar index. It touched 99. What does this weakening dollar mean for equities? And specifically, Bob, what does it mean for gold?
Well, it's interesting. It's not having the effect on gold that you would think unless there's this contrasting effect in the economic data. So you're looking at a weaker dollar having much to do with the increased issuance from the Treasury, which I guess portends higher yields, but isn't really taking higher yields to that place.
And lastly, Bob, commodity prices historically and typically welcome a weaker dollar. The prices will move higher. But do we have to throw that out the window as we're in a post-COVID-19 environment? Commodities and that historic relationship is maybe a little dislocated?
I definitely think it is. I think it's a component, but this is not an all else equal situation, as you point out.
All right, Bob. Well, thanks. As always, we want to thank you for tuning in to Striking Options. And please tune in every week as we will continue to strike options.